always interesting to listen to him. Aditya Suresh is now joining us. He's head of India Research and Strategy at Macquarie. Aditya, great to have you with us here. Thanks very much for your time. Prashant this side. You know, we are back at new highs. But Aditya, I just wanted to ask you, what is client feedback from global investors like? I mean, you'd have constant back and forth about ideas, about you telling them what they should be doing and kind of pushback. It was interested in, is there the same level of bullishness amongst global investors for India as there is amongst retail local investors?
Prashant, thank you for having me on the show. So I think the key observation is just that there is this big dichotomy again, right? Which is that you do have a lot of investors very concerned about valuations, right? Where India's valuation premium is at. But in the same token, you do have another set of investors who are looking at India on, say, 3, 4, 5 year kind of time horizon, right? And therefore, they'll be kind of looking into the pullback. So it is, I don't think there's a consistent theme or message, but I think there's a general acknowledgement that, let's say over the next, say, 6, 12 months, that perhaps in a relative sense in emerging markets, we do underperform some of the other kind of other markets here, just given the fact that where valuations are at.
Hi, Aditya. Morning. I will get to your anti-consensus call that you took on IT the last time around, and that worked pretty well. IT has come back in style. But let's focus on the earnings first. The past quarter's, earnings numbers we have, I believe some part of the street is still a little bit cautious that we're not going to get that 15-16% that earlier we thought for the next 2 years is a given. What are you factoring in terms of earnings growth? Because ultimately, earnings is going to drive this market higher.
No, absolutely, Nigel. So I think when I said plus 15%, plus 16%, that's in the MSCI India.
Okay.
And that's rolling 2-year forward basis. We still maintain those estimates. And there are kind of, in my opinion, good reasons for that, where, for example, in financials, the expectation is high, and we've actually been revising numbers upward. With IT, some of the cuts to margin that's already in the base, is our opinion. Consumer, again, similar kind of theme. So there are quite a few underlying support factors where at least the optics of this is going to support that 15% growth from an MSCI India perspective. From a Nifty perspective, I think there the growth is going to be more like, say, 10% thereabouts. So there is a disconnect in terms of Nifty versus MSCI India, where MSCI India, the growth is a bit higher than just in terms of the underlying constituents as well, right? But the key theme is that, so when you think about earnings growth in a relative emerging markets context, we're looking at plus 15 still, even after these set of results. In that setup, EM is at plus 5, world is at plus 6. So this entire growth outperformance message, I think, still continues to be maintained. The only kind of challenge for India is that it's now in the base, right? So it's already in expectations. So incrementally, I don't see us rallying from here on the back of this earnings growth, right? So when you think about plotting, let's say MSCI India versus 2-year forward earnings expectations, there's a very, very strong correlation over the past 20 years, right? And to the extent that that regression holds, then the key theme would be to take away that there's a bit of, we're probably overbought here a little bit, right? So we do see some pullback here on MSCI on the back of that. But yeah, 15% growth is still a fairly strong number.
Aditya, but high valuations rarely ever cause sharp corrections. You need a trigger for that, right? So what it can do is just cause time correction, prolong how long market sort of stays sideways, right?
No, absolutely, Prashant. So I think one of the main themes which we speak about as well is that when you think about India's valuation premium, yes, we're at 19 times 2-year forward on the MSCI India, and that's at a +3 standard deviation premium on the premium to EM and kind of the world. But are we saying that on its own is a factor which is going to therefore lead to a kind of multiple compression? We're not, right? So I think there are India-specific factors which kind of supports the multiple where it is at. So we're not saying that valuation on its own is going to be a negative here for India from a kind of derating perspective. I think that premium to EM kind of compresses more about what happens to China, what happens to Korea, what happens to Taiwan, that type of stuff. I think the one specific factor which at least I'm concerned about is that if I take the story here over the next, say, 12, 18 months, what happens to kind of domestic liquidity in the face of kind of high fixed deposit rates, right? So I think the key piece over the past, say, couple of years has been that at least as a team, we've had foreign selling, but domestic kind of support, right? And at least the way we think about it is that it's a bit of the reverse of that going into the next 12 months, where at the margin, we do expect kind of some foreign buying. But at the margin, we do think that domestic the liquidity, which has been ample so far, that kind of recedes here in the face of kind of high fixed deposit rates.
Well, Aditya, the IT space surprised everyone. Just when everyone was throwing in the towel, I think from the end of September, that's been one of the big outperformers. You all had an anti-consensus call, I think, on being positive on IT, as the earnings cuts, according to you all, were already in the price. What's your take on it? Will you stick to the large cap IT names, or do you believe some of these mid cap IT names as well, post the correction, they offer value, or are they still far too expensive?
No, we're still sticking with the large cap IT names. I would still say that our view is again premised on the fact that we think that the peak attrition is kind of behind us. The margin cuts are already in the base. We think fiscal 24 margins gets kind of revised upward. I think offsetting that, we're still concerned. We're still concerned about kind of the revenue growth, kind of which is kind of baked in numbers. So it's not kind of set in stone. But given the valuations are at, I think that's kind of, in our opinion, is adequately kind of captured, right? And so if I kind of think about some of these large caps are trading at, say, 15 times, 20 times, that 25% kind of ROE outlook with still strong free cash flows. On that basis, we do get constructive. It's still not a completely de-risked trade, if I may, though. We're still positive in the space. It's still one of our biggest anti-consensus kind of positions from an India perspective. But I think there are still challenges to work through. It's reflected in multiple.
Okay, challenges to work through, but in showing up in multiples. Aditya, which are any new themes you've initiated coverage on? Has the market forced you to do so? I mean, defense, for example, there are some of these, railway stocks. I mean, I know these are more cyclical and they fade in and out. So maybe leave rail aside, that segment aside, but defense is perhaps here to stay. With a strong push. And the biggest buyer is the government of India, and they want to buy more from Indian companies, right? So are you getting interest from foreign clients for this sector, coverage, initiation, etc.?
So I can't speak about coverage, and this is a space which we don't cover as we speak. But in terms of interest, that's clearly where the interest is at, right? So like in terms of, again, taking that 3-5 year kind of perspective, a lot of this kind of localization theme and kind of the small mid-cap ideas within that is kind of where a lot of the interest is at. So I would say that first is the theme itself, I think, makes a lot of sense. And I think there is a structural kind of undertone to that. And it is kind of something which, I think people are getting behind.
Aditya, I think you had a view on the OMCs, right? What's your take? We have crude oil prices that have corrected quite a bit as well. What's your fresh call? I think you had a buy on all three OMCs.
So we still have the buy on all three OMCs, but that's clearly a tactical position, Nigel. It's I think it's hard to get fundamentally bullish on these OMCs, just given the volatility of earnings, right? So for these to be fundamental kind of calls, it's got to be more backed by a more stable path in earnings, and we're not there as yet. Within that entire kind of energy space, I think the gas names look far more interesting. Some of the midstream gas names. So we do have quite a few kind of, let's say, a few ideas there where I think stocks say double on next couple of years.
Okay.
But a lot of it is again, it ties back to what's in the price, and like some of these stocks at 4 times, 5 times PE, with I think a dividend angle to kind of think about, and the thematic is there to support as well. So current environment is still challenging given where LNG prices are at. But if you take an incremental call for the next 12, 18 months, I think some of these things could look interesting.
The gas distribution companies?
Now, this is more like the gas midstream names. So gas distribution, I think one of the challenges in that space is still about, you still need to take on incremental kind of price hikes, right? And you're already kind of at peak kind of prices. And so we're still concerned about kind of the fact that you're sitting at peak margins. Volume growth is kind of subdued in this high price environment. And so even if I had to take a tactical position that, what's the gas price locally are cool, and therefore there could be a trade on city gas distributors. Fundamentally, on that 1 to 2 year kind of time horizon, it's a bit more challenging to kind of do that unless you have a strong volume growth outlook, which I think I'm finding it a bit challenging to kind of make the case there, given where prices are at. So the midstream names, I think there's a lot more value than the downstream.
Okay, all right. Where else, Aditya? What else is sort of catching your eye, and kind of where are you more bullish on, earnings led?
Yeah, so I think coming back to that anchor position of say plus 15% 2-year forward EPS growth on MSCI India, right? So I think the key theme is about high expectations and financials on earnings, and that being that's been revised upward, right? I would still say that financials is a super consensus kind of position, and therefore that it's a crowded trade, and that makes me a bit nervous. But in terms of earnings growth in itself, I think financials is well positioned as a space which we like. That's one. We touched on IT, where we have an anti-consensus kind of positive. The other area which I think is interesting is on industrials, where the key theme which you're speaking about is just the fact that when you look at the state of government revenues and kind of expenditures, yes, we're still looking at a fairly large deficit that's not to be ignored. But compared to where we were marked at, revenue is kind of tracking above expectations. And that's been a broad base in the kind of tax base. That's kind of been helped really by your formalization kind of themes. And that therefore is allowing the government to kind of spend higher on capex, right? Which has been above at least our expectations. And so when you think about these kind of industrial companies and the kind of backlogs which they're sitting on, plus typically the execution of the backlog, you'll see that margin expansion kind of story coming about as well. So industrials is an area we like. Everywhere else is a bit more bottom up. Consumers is a space where we struggle with, at least from a top-down perspective. I think, maybe one small slice of the consumer is doing well, but whether it be urban mass or it be kind of rural, that's still kind of challenging. So consumers probably an area where we remain most cautious. Financials, like industrials, probably more constructive. Beyond that, it's more kind of selective bottom up.
All right, Aditya, I wanted to ask you about this auto trade. Besides banks, a couple of months ago, auto was the big theme. In the last 1 month or so, the index itself has done a relative underperformance out there. Tata Motors has a set of issues. If you take a look at it, the Nifty in the last 1 month is up 4.5%. The auto index is as flat as can be. What's your take on it? Because the chip shortage issues are going back. Demand is rock solid. Production is ramping up as well. And margins could improve. But how much of that is already in the price? And if you are, if you have a view on auto, tell us which segment would you like? Is it the CV space?
So again, from an auto's perspective, a lot of this, in our opinion, is so we've been positive in that space for the past, say, 12, 18 months, right? At today's levels, do we selectively like a few bottom-up ideas? We still do. It's some of these names which you were kind of alluding to in the CV space and the two-wheeler space as well. Incrementally, from a top-down kind of perspective, is this an area which I'm feeling comfortable with? Less so, right? Given that I think a lot of this kind of optimism is already kind of baked in. I am kind of still worried about where consumer sentiment is at. Again, in the medium term, that kind of is going to weigh on volumes. Is our opinion. In terms of the earnings growth in itself, a lot is already in the price, right? In terms of whether it be the new model launches, the demand kind of upcycle. With the demand upcycle, the kind of margin expansion, all of that is already in the numbers. Like, for example, EBITDA margins, that space, consensus is already kind of factored about a 300 basis point expansion in margins in the next 2 years, along with that kind of upcycle, which has already been kind of forecast. So again, is there a surprise element within autos, which therefore leads us to kind of be positioned more there? I think that trade is largely played out, Nigel, is our opinion.
All right. Aditya, the other one which has caught the attention on the downside is all these, new age themes, right? Delivery companies and the like. Sharp correction across the board. I mean, fintech. Anything looks interesting with stocks that you have coverage on here?
So we do selectively like a few stocks in that broader kind of, let's say, new economy space. For example, I think the online travel space is interesting. We have coverage of a name listed overseas. And there, I think the biggest kind of point which we make is about the fact that we don't have to draw any boundary conditions. At least we don't feel we need to draw any boundary conditions on who the target audience is at. It's more of a volume play and then greater kind of online penetration, all that stuff, right? So that online travel space is interesting. There is a theme about consolidation, potentially kind of higher kind of improved kind of take rates over the next kind of couple of years, better margins, etc. And that space is already kind of profitable, right? So that's a space which I like.
That's make my trip, I'm assuming, but that's.
So we cover Make My Trip. We cover Make My Trip. So I think that.
Anything here you want to talk about? I mean, anything, obviously under coverage.
Yeah, within our coverage, so most of these names we are cautious on, and the key theme there is on at least with names which are kind of listed here, one of the main points is about the lack of growth momentum in some of the kind of let's say food delivery space, etc. And the other theme is about just the path to profit, right? And we think that that's a bit more prolonged than where expectations are at.
All right, Aditya, we'll leave it there. Thank you very much for joining us. It's a great conversation as always. And thank you very much for making it to CNBC TV18. Thank you. Let's just look at the SGX Nifty. I mean, it's indicating, I think, about a 25, 30 odd point cut. So it's not, anything substantial, anything large, but it's indicating a slightly lower open. US markets, of course, were shut. Asia is not doing anything great, anything decisive, actually. And I think that's the way to put it. Some markets are slightly down. Hang Seng, for example, is down about 1%, a full 1% now. But there are other markets which are slightly higher by about a 1/4% or so. So, one way or the other, if you're looking for directions from global markets, not very much. US futures, which were higher, they've gone absolutely flat. So almost unchanged at this point in time. We'll take that break. We are back with technical trading ideas. We'll have Srikanth and Mitesh both joining in